Alrighty. Hello, everybody. Welcome. Oh, my camera isn't loading for some reason. Okay. We'll just continue without the camera then. I don't want to screw around with the stream and whatnot again. I can live without the camera for now. Sorry about that, guys. Hello. Hey, Manas. It's been a while. Nice to see you. H2O. Also, nice to see you around here as well, my man. Very, very, very happy to see you guys on and around. I need it unlocked because there's an email lock on it. No. You'll have to message me in Discord, so then you can share more information with me, and maybe we have to do something with WAP to get whatever you need figured out. But the best way to contact me is actually through the support chat on WAP, and then to continue the back and forth there. Or you can try and message me privately on Discord. Those are the two best ways to reach me. So, let's get into stuff. There's been a few things going on in the world. But understand where I'm coming from. I just spent like the last 3 days going through a whole lot of reports. I don't know why, but just so many reports got released in the last week. And a lot of good, detailed reports as well. One of them actually came here from Merrill Lynch and is covering the US midterms. And you can see we have the chart right here. So here are the corrections in the months. This is the cumulative correction in the months leading up to midterm elections. So the average drawdown for the S&P 500 between the months of June and October in a midterm year is about 12%, close to 13%. And maybe you can just see, just by looking at this data, why I'm not a huge fan of an average as a robust statistic, because you can see that the average is being pulled down massively by this data point in 2002 and this data point in 1974. So if we were to look at like the median would probably be closer to 8%. Now we've already fallen, if I delete this now, we've already fallen, I think, closer to like, let's see here, it was between June, right? So it seems like between here and here, yeah, we've already fallen about 5-ish%. So it's really not the end of the world, you know? It's really not. If anything, it seems like, because it's measured as a total peak to trough thing, this is already this isn't far off from the median drawdown of that chart. So I honestly wouldn't be too surprised if we continued to move up from here on the S&P into the midterms. Now next month I'm pretty concerned because you can kind of see all the odds are relatively flat, right? 17, 17, 14, 14. These are seasonal odds, of course, but you know, the odds for this particular, and also I'm gonna turn down the music real quick because I'm seeing that it's, yeah, there we go. It's a little more quiet there. Don't want it overpowering my voice, you know, and all that. Hey, Kari. Nice to see you. Yeah, guys. Again, if you have something you want me to check out or commentate on, especially if it's like a macro theme or something, definitely let me know, because we're going to be going over some things. So that was really nice. We can actually pull up real quick that report from Merrill. Sorry to flashbang you, but this is the report where that chart came from. And you can see right here. How will the midterm elections impact markets? A correction pre-election wouldn't be out of the ordinary. In the near term, the lead-up midterm elections can be more volatile before the typical relief in policy uncertainty post-election. So this is just regarding central banks. And also fiscal policy uncertainty around who actually is getting elected and getting into power. Looking back at midterm election years since 1950, the S&P 500 has seen an average drawdown of 12.7% between the start of June and the end of October. A correction in the coming months wouldn't surprise us as the market catches its breath and searches for new catalysts after a strong rally. Again, my thing is we've already had this 5% move, and if you again look at this chart, this average is really getting skewed lower by these two specific years. So I'm more in line that the median would be the more accurate move, and that would be somewhere around like 10%. So 12.7 seems to be a bit of a skewed statistic here. And then they go ahead and say, hey, looking past November 3rd, there'll probably be a rebound, essentially. Which is nice to see, you know. That's nice to hear. And we can't just automatically extrapolate that information to other indices like the Russell or the NASDAQ. But you know what? The Russell has been doing absolutely phenomenal. I mean, look at this. Since the beginning of the year, like, it had a rough period here, but man, it's up 20%. The S&P, oh, let me hide all the drawings. The S&P since the beginning of the year is up about 8%. The Russell is doing so much better. And guys, it's coming from a diversification effect. There's a lot of companies, manufacturing companies, that are seeing a big boon right now because there's so much demand for AI stuff that all the related infrastructure to support that growth is also expanding. And what matters is the rate of change. There hasn't been such a huge growth rate of change wise because of the demand for AI in a long time. So construction and energy related things, and also some manufacturing related things, there's been a lot of, like, suddenly a big data center comes into the city and says, hey, there's like 2 small manufacturing workshops that are professionally run. We're going to send as much as we can to those 2 workshops, and then we have to outsource everything, as much capacity as they can handle. So there's a lot of companies taking in an absurd amount of orders for all sorts of supportive infrastructure and manufacturing needs of the AI grow out. So these companies used to be doing like a few percent growth, right? They'd be doing okay. And now they're getting all of these massive orders, and then their company just, in some cases, like doubles, like absolutely explodes. because of the sheer demand. So when you have a really small company, and Russell has a lot of small companies that are exposed to that investment, the Russell actually has been doing pretty damn well on a relative basis. Which is, you know what, great to see. It's a broadening out of and a diversification of the investment, which is really nice to see. There's been a lot of commentary of that as a major risk for a lot of AI related things. Let's see. There's one more macro related thing regarding the June NFP. You guys remember this thing, the June NFP? How it came out at like 50,000 and the US dollar like rallied really, really hard on that June NFP. Yeah, right here. It was a June NFP report that hit the dollar. And when I meant rally, I meant fall. It got hit really hard, that June NFP. Well, I was reading it says the paste was too large. Oh no. Well, we can bring up the thing. There's a particular chart from ABN AMRO. They had an article kind of dissecting the US NFP report, and it kind of makes me a little uneasy. Watch out for the flashbang here. Can I like zoom in enough? Yeah, there we go. So this is the chart I'm looking at. But here's some of the things we're concerned about. So yeah, let's see here. Non-farm payrolls increased to 57,000 in June, well below the consensus. All right, that's the background. Yeah, check this out. Yeesh. The latest data on the left, this chart here, extends the point. Participation has fallen 0.9 percentage points since December, from 62.4 to 61.5. Over the past 20 years, declines of about 9 percentage points, 0.9 percentage points. Declines of this magnitude have only occurred during COVID and the second half of 2009, when discouraged workers left the labor force after the Great Recession. So this is a really bad participation rate. So what's the issue with this participation rate? Where is this coming from? And they're saying, hey, the decline is coming from two places. First, people retiring who are older than 55. And second, and this is the worrying part, development is, my bad, I'm kind of screwing up what I'm saying here. First is 55 plus year olds retiring, and then it's estranged 25 to 34 year olds who are massively declining in the participation rate. This is harder to explain and appears to be driven mainly by the June print. So it could be treated with more caution, especially considering the fact that employment in this category also saw a larger than usual drop. So this, when we look at this chart here on the right, you can actually see that these bars are color-coded. Yellow is the concerning part. About as many people who are leaving the workforce for retirement reasons in the US are of almost prime working age, right? 25 to 34. Guys, these are, I can't tell if this is just like a really bad job market or these are just straight up NEETs, right? Like this is bad. Now, we did just have a bunch of layoffs, right? That could also be impacting this specifically. But is that enough to completely justify it? I'm not an economist. I'm not totally sure. That's why I go out of my way to find this sort of research and see what kind of points economists who are doing the research are making. And then I'd be like, okay, that kind of makes sense. Okay, that kind of doesn't make sense. But this is a spot that frankly needs to be watched. If this age group, let's say, continues to go into the preceding age groups and essentially stay neat, not in education, employment, or training, right? If we have this kind of neatness continue from one age bracket to the other, this could be just structurally bad for U.S. economic metrics. So it's something I'm going to be watching out for if it becomes a trend. Okay. There is one more kind of weird report that I do want to bring up. And by weird, it's mostly relating around commodities. And I'm not talking about hard commodities like oil and gold, right? Oil is doing... it bounced up a little bit here. And then gold has been doing a whole lot of nothing here. But what I'm talking about are soft commodities, right? Cocoa. Like, look at cocoa. It has been doing absolutely phenomenal. It's up 60% here. Like, it is doing pretty well in the last month, right? Like, you guys want to talk about oil all day. Well, man, the soft commodities are getting hit particularly hard. Let's look at coffee. Look at the price of coffee. 38% higher. So coffee and cocoa, soft commodities, right? And I believe we can look at wheat. You know, this is rice. Yeah, you can see rice is also going. It recovered from this drawdown. It's going to new highs. And then what's this? That's whole milk. Ooh. Whole milk powder futures. Yikes. The New Zealand guys are not going to be happy about that. And then this is urea. Soybeans. Oh, shit. Look at soybeans. Shit. Soybeans did pretty phenomenally here. And then that's gasoline. Oh, and then I believe that's wheat up here. Yeah, and wheat's also going up. So all the hard commodities like oil and gas and copper and gold and silver, all the hard commodities are doing kind of all right. They're not falling through the ground so much. And outside of powdered milk, a lot of soft commodities are rebounding and are doing pretty damn well over the last month. So why is that? What's going on? It's the weather. Actually, in the Discord, I made a new channel here called Weather. And you can actually see we are following developments on the weather because this significantly impacts not just soft commodities, it turns out. If you are watching the weather, and I mean, how about this? If you're watching football, you know right now, everyone and their mother is talking about how hot as shit it is, right? Everyone is talking about, oh man, we gotta get air conditioning. Oh, the Euro pores, da 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 da. Everyone's talking about how freaking hot shit it is, right? I mean, look, I'm in Vegas. The last week, it's been hitting 110 for like the last week and a half, 2 weeks, almost every single day. I cannot fucking go outside. It is too goddamn hot. But weather is the primary thing. So this other thing we're going to be bringing up is UniCredit's El Nino analysis here. And you can actually see that here is the full chart of the thing that was posted in Discord. El Nino has returned and could strengthen sharply by late 2026, bringing greater risk of droughts, floods, and heat stress. Elevated energy and fertilizer costs linked to the war in Iran could amplify the impact. Food inventories could cushion part of the shock, but the balance of risks for prices is still upward. So, simply put, what this really matters for, not just if like, oh, I'm trading tech stocks. Why does this fucking matter to me? It does matter to you, idiot, because it's going to move inflation. So if shit gets really, really hot and there are droughts and more demand for energy, well, that's going to send energy prices higher. And the droughts and the floods and the heat is going to make it really, really hard for people to farm more food. If it's harder to farm more food, guess what ends up happening? There's more volatility in the food component for every single country's food CPI component. So you could end up seeing over the next quarter, because guess what? El Nino is not over yet, right? You can see here, hey, here's the odds of a very strong El Nino. It tops out October, December in the fourth quarter of this year. So we are by no means done. Guys, we are over here. We still have all this time to go through. Like, it literally into the end of the first half of next year. Until this is over. So we could very easily see, like, for example, in Japan, rice is a really big problem. So if we go back to, I don't know, the rice futures. Oh, that's lumber. Okay. This symbol doesn't exist. How could the lumber symbol not exist? Okay, so this is rice, right? Yeah, that's rice. You can see rice has fallen off a cliff here. And then here, I believe February, March, April. Around here is when we had the war in Iran, and now we're seeing the El Nino kick in. So how high can rice go? Because this is actually going to be a major component for CPI for Asia countries. So if you're worried about things like Japan or the Nikkei or the BOJ monetary policy, because guess what? If they continue to change that, that's going to keep unwinding a lot of trades, right? So just take this into consideration. Rice is actually quite important geopolitically for inflation and stability in the world. And we are really hoping that there is enough, like what these guys say, hey, you know, hopefully there's enough, you know, stockpiled food and whatnot. But this is really bad. So let's see here. The baseline for food markets remains relatively contained, but upside risks are building. Let's see here. They expected, so there was this huge commodities outlook released by the World Bank in April of this year, expecting a 2.5 increase in the global food commodity price index this year. Well, we'll probably see a bit more than that if we see this extreme El Nino risk realize itself. Global agricultural production could fall by 14.3%, implying a $342 billion lost in agricultural production. Price shocks could reach 10 to 50% across core commodities, while the most exposed crops, including rice, which was what we were just looking at, palm oil, sugar, and coffee. Coffee is also one we were just looking at, could rise by 50% or more. It's a kind of a big deal. If the food component of CPI around the world goes up like, I don't know, 10%, don't you think that's going to be a cause for concern? And I'm not talking like, oh, it just goes up like a moderate, a surprising amount for 1 month. Guys, this could be for like month after month after month. This could be multiple months in a row, to the point where it starts impacting wages. Where some people are going to argue for higher wages because the food costs go so high. Where some people start making budget cuts to other products because the prices go up. Now, I sure as hell hope that a lot of food manufacturers and producers, that they're on the ball on this already. And they're trying to stockpile stuff. And they're trying to make sure that they can keep their prices low for as long as possible. Because if they let prices rise and rise, enough to be readable in a surprising fashion for multiple months in a row, for multiple countries' food CPI component, you can very easily end up with a much tighter monetary policy around the world much more quickly. And that would end up killing quite a decent amount of growth in a lot of places in the world, which we seriously do not need right now. We want to keep the growth train going. For policymakers and investors, the priority is resilience, keeping trade channels open, strengthening early warning systems, securing fertilizer, improving water efficiency, and diversifying sourcing are no longer just sustainability objectives. They are macro stability tools. The food system enters the second half of 2026 with buffers, but with little margin for error. So hopefully we don't get a super, super extreme El Nino, because that will cause a lot of food volatility problems. So that's something we're going to have to watch out for. And thankfully in the Discord, we actually have a channel. It's the National Hurricane Center weather channel, but let me see if I can pull this up real quick. On X, I actually have a list for people that follow, weather watchers. Here we go. It's only got 8 members in it right now. But you can see here, weather watchers. And hey, precipitation forecasts for Texas, severe thunderstorm watch, observatory Hong Kong, very hot weather warning is now in force in Hong Kong. Tsunami info for, I believe, Japan. No, this is for Alaska. National Tsunami Warning Center. So there's a tsunami warning right now in Alaska. Strong to severe gusts of wind in central Arizona. Again, this is a lot of U.S. stuff, but that's just because the U.S. tends to do a lot more reporting than a lot of others. But I have 8 official weather national services in here. And if they start mentioning stuff around El Nino, oh, and then here's one of the forecasters, right? typhoon season, the earliest start for a season. There's actually a meticulous calculation on this. Oh, the earliest start for a named storm since 2019. Earliest first super typhoon since 2018. Each month saw at least one named storm for the first time since 2015. All years were El Nino or developing El Nino. So we could see Pacific typhoons really start to kick up here, which would not be great. Depending on how destructive they are, because if they are extremely destructive, you're gonna end up, depending on how destructive it is, a really significant economic hit. So I'm actually gonna copy that and share that in the weather channel over there on the Discord. Does this make sense to you guys, right? The weather being a huge factor in inflation going forward, right? Typhoons approaching China, heavy rain. Yeah. Okay. There are a couple more things. I know we're half an hour in now. I've probably covered enough just to go over the stream, but there's actually some fiscal policy things I wanted to talk about, and some things actually on currencies. So just to kind of mix it up, based on the stream's topics, I'm actually going to bring up euro dollar here. So here's the euro dollar, and I'm going to oh, didn't mean to do that. There was some particularly good euro dollar analysis here. Yeah. So let's see here. Where do we stand and what moves the euro dollar next? Let's see here. The ECB's remaining hike is largely priced and capped. Yeah, it's September, I believe. The ECB's expected to hike in September. That's the next spot they're expected in. While the Fed path still carries the larger two-sided risk because they could end up hiking still instead of staying on hold. It can extend if inflation oil accelerates. And we just went over like, hey, if the El Nino inflation concerns start to materialize over, let's say, the third quarter, we could end up with a rate hike actually before December. We could. If the El Nino this year gets considerably bad, that it creates more significant food volatility in the food components of CPI, and it goes on not just for 1 month, but for 2 or 3 months, to the point where it starts impacting spending in other categories, then you could end up with the Fed hiking rates for what's essentially a supply side problem. And that's actually really bad. Look, I get when you see inflation going up, the impulse really is to hike, but the Fed will look through the initial inflation impulse for food volatility over maybe the first 2 months. Like by the second month, they might be concerned, but they could look through it over the first 2 months. But once it becomes obvious, like, hey, this is a systemic issue, you could end up with a more hawkish Fed by the time you get into the third quarter here, if that food volatility starts to pick up due to El Nino risks. And also, El Nino increases the heat of things, so that increases the likelihood people want to use energy for air conditioning. So energy prices also go up, commodity prices, demand also goes up, and you end up with just a lot of additional demand for less food that's available and just the remaining energy that we currently have. So I'm just being very explicit. Hey, there are some risks around inflation coming up here in the next couple of months that a lot of people are not focusing on because they're not aware of, hey, when you're doing trade research, you're actually also supposed to look at what other institutions are saying. Believe it or not, the weather actually is important. Believe it or not, food actually is important to your forex trade, is important to your global macroeconomic analysis. Weather actually is important to those things. And if you ignore them, then when something starts to get significantly worse, you're going to be caught with your pants around your legs, around your ankles rather. It's going to be really, really bad. It's kind of the same thing with people who trade politically exposed assets, but don't follow politics. Now, every asset is exposed to a different degree to politics, and also that correlation changes depending on the politics of the day. But to totally ignore it, how do you know when a political event or an election is actually important for your assets exposure or not? How do you know? Right? You don't, because you're not actually looking at the information. And if you know nothing about what's going on politically, it's an unknown for you. Right? So it's worth being interested in the world. It's worth being interested in a lot of different things. The more you learn about the world, the better at trading you get. But what I like to say is the more you learn about the world, the better at life you get. And, trading can be a part of life if you want it to be. So let's see here. In the following sections, we break this down. First, we take stock of the U.S. backdrop, inflation, labor, and what the market now prices to assess whether the case for extending the Fed's tightening path is strengthening or fading. We then turn to the euro area, where the question is the mirror image, whether anything in the data could force the ECB beyond the single hike already discounted. Finally, we add the war overlay in Iran, right? The one force that could override both backdrops. The El Nino stuff also is a concern. It's just not as much of a concern because it hasn't significantly materialized itself yet. Before translating the asymmetry to our euro-dollar view. Okay. Here's some scenario analysis. So for euro-dollar, with Iran, if there is de-escalation, we're going to see Brent back below $70. How obvious. Fed rate hikes get unwound and euro-dollar recovers. In the risk case, we get a renewed oil shock, Hormuz disruption. I'm surprised that they don't put in here risk of Bab el-Mandeb closing, right? Because Bab el-Mandeb, which is the path into the Red Sea from the Omani Gulf, right? Into the Mediterranean past the Suez, right? Know your geography. Oh my God, now you got to know geography and the weather and politics. Oh my God, you got to know so much stuff for trading, guys. That's just how the world works. That's just how the world works, Know your geography too. That's actually kind of important. You got to know where these places are in the world, right? But yeah, so escalation in Iran leads to these things. Fed tail reinflates, US dollar risk off bid, euro terms of trade hit, euro dollar lower. It's yeah. That's a reasonable risk case, sure. Core PCE remains the Fed relevant hawkish lens, so the case, yeah, it remains it, but you know what? Now that we have the task forces, Warsh's task forces, Warsh's boys, going through rummaging around the FOMC and conducting their own studies on what are effective economic statistics and metrics, you could end up with new inflation measures. You can end up with new interpretations. We really are waiting on what those task forces come out with. And if they come out with anything incredibly surprising, honestly. So that's U.S. labor, market repriced to cut from cuts to a possible hike, but not to a sustained cycle. Yep. There we go. For Eurodollar, the next question is whether this backdrop will still has enough force to push the U.S. front-end rates higher. So when they're talking about front-end rates, they're talking about like 1 year, 2 year, 3 year yields, 6-month yields, all that sort of stuff. Bond yields, right? The Euro is the quieter half of the pair. One further ECB hike is priced. The question is whether anything in the data could force more. Okay. Oh, yeah. Below test 3 candidates, whether the HICP, which is their inflation metric, overshoot is broadening beyond energy, whether wages show second round pressure, and whether the activity stabilization is strong enough to support an independent euro positive story. Our answer to all three of these is no, which caps the European leg and shifts the burden of the euro dollar view entirely onto the Fed. Yeah. Let's see here. Okay, for euro dollar, the trade is not long Europe, it's fade Fed hawkishness extension unless transmission reappears. So this is like the point when I was reading this article and I was like, oh, that's actually really useful. That's actually a really concise way of putting how a lot of institutions are currently viewing FX and Eurodollar right now. The trade isn't necessarily explicitly risk on. There are definitely positive things about Euro that are occurring right now, like the ECB rate hikes, obviously. But there's enough underlying uncertainty about inflation, and now with El Nino around the corner, and also a potential reacceleration of the conflict in Iran, you could end up with higher energy prices and higher food prices and keep those prices volatile over the coming months. And that could induce more hawkish policy, not just from the ECB, but from multiple central banks. How many times do I got to repeat myself, right? So I particularly liked this here because, hey, that's not necessarily a long Europe trend because the ECB is hiking, quote unquote. It's fade the Fed hawkishness and events that make the Fed hawkish, then you pull out, right? So right now things are going well. The Fed isn't going to try and do anything crazy. All right, cool. As soon as the Fed starts saying, hey, we are concerned about this El Nino inflation. Hey, we're concerned about how this can, if it goes on for 3 or 4 months, that we start saying this volatile food and energy inflation, also assuming that there's an acceleration with the war in Iran that limits off how much energy. I do have to say, though, as a tangent here, the energy issue with Iran getting blockaded again and potentially re-escalating, it's not as big of a deal at the moment. Because when the blockade was lifted, a lot of oil got out of Iran and went to a bunch of countries that really, really needed that oil. So with that oil now in place, it's not there's not as huge of shortages. Like, for example, in Japan, oh my god, I think I have it like right here in my notes. In Japan, yeah, on June 11th, the Prime Minister Takaishi announced that Japan started to receive a lot of oil from the United States and Canada for the first time. June 11th, that's a month ago. And they're going to start receiving oil imports from Mexico this month. So now the government of Japan is like, hey, we're confident that we now have enough oil and new stockpiles and new supply routes for Japan to have enough oil to last us at least until March of 2028. So there's a lot of countries that did the exact same thing as Japan, maybe not to quite the same extent because maybe they don't have the same relationship with the United States, some European countries likely. But all in all, so I'm getting a little distracted because it looks like the stream's frame rate has like dropped like 50% and I'm getting errors. Man, I wish I knew what was causing these streaming problems, Anyways. Yeah, this was a nice thing to read. Also, there's a whole bit of analysis here. Euro-dollar implication, scenario, overshoot fades, upturn towards 16. Fed hawkishness deflates. We're going to 118, 120. Confirmed break. Euro-dollar going to 112, 113. Summer regime split. De-escalation versus re-escalation. Yeah. Oh, check this out. The July repricing pushed the US Euro 2-year differential back towards levels historically consistent with Euro-dollar around 112, 113. The spot held closer to 114. Through both the rates moves in this week's escalation, Euro-dollar spot is therefore not fully violating the downside signal from rates. Kind of hard to read that. Oh yeah, that has been true. That bit on the rate differential. And then this is the scenario split. So if all the rate hikes get unwound and the Fed just stays perpetually on hold, we're going to see 118 to 120. And we're currently sitting at 113, 114 right now. So this would be kind of a big deal going all the way up to there. That's a lot of money. That's 500 pips. Oh, probably 4 to 500, 4 to 600 pips. Man, the stream's going on quite a while just to go over this one bit here. And I still want to cover the Japanese fiscal policy, UK's fiscal policy, and what's going on with Keir Starmer getting replaced with Andy Burnham. And then there's also what's going on right now with Le Pen getting in and running as president of France. But man, we've been going on now for about 50 minutes. So I'll say, if you want to read more about those things and the research I've done around those things, if you've watched this far, feel free to hop into the Discord and ask me. But all in all, I'm very, very happy with what I've covered so far in stream, especially in the first half. The second half, focusing more on just reading through these reports, is honestly can be a bit of a slog. However, one thing I will say for those other topics, there's been a lot of focus on what will the response in markets be, for example, if Le Pen gets in. Well, right now the expectation is that the euro would go down if Le Pen gets in 2027. I'm not entirely sure that's going to actually be the case when that happens, but right now Le Pen is the front runner in the first and the second round of the presidential election, which is kind of insane. This is like the first time that's ever happened for Le Pen. So she's got a really good shot now. And then for the UK leadership election for Labour, the Labour Party, Andy Burnham's going to come on right on in. There is concern around, like, hey, what's exactly he going to do to fiscal policy when he becomes prime minister? And it seems like the bond markets aren't pricing in very much. So if we go to UK 10, GB 10, yeah, there we go. Bond prices have been steadily going up. And then if we do, of course, GB 10Y, oh yeah, there we go. Yeah, it hasn't been crazy. So wait, were both of those things the same chart? Yeah, that's too weird. Those should be different charts. Let's see here. The yields, the 10-year yields, are about 150 basis points higher. So they were over here when the report was made, and now they're like way up here, and they've pulled back a little bit. Due to recent inflationary pressure. A greater share of gilts are now held more by price-sensitive investors and for trading purposes, amplifying the sensitivity of gilt yields to global UK-specific shocks. So there's a couple of groups that are looking at these yields. Essentially, as soon as there's a major announcement by Andy Burnham on fiscal policy, if he makes a major announcement and then there's a big reflexive move in UK government bond yields, then that's how markets are interpreting that particular announcement. Even if there's the rumor of an announcement and the market moves on that, that's generally how markets are going to be interpreting it. So we're going to be watching, okay, what is Burnham saying? What is being rumored that he will do? And based on the totality of all the information we get, how are markets moving in response to that? And then what fraction of the market move is actually based off that information versus other information. There's also some stuff going on with Japanese fiscal policy. There was a lot of rumors saying, hey, the Japanese government wants the Bank of Japan to start cutting rates, or at least to stay on hold. And it doesn't seem like that rumor is going to stick up. Right. Let's go to dollar yen. The Japanese are really, really, really concerned about the strong yen right now. So the Bank of Japan feels like it's still pretty A-okay just to continue to hike. Again, the extra fiscal policy from the Japanese side, they think it would be easier in achieving their fiscal policy goals if the Bank of Japan did have easier monetary policy to just pump a bunch of growth into Japan. But the politicians just outright came out and said, no, we do not want to try and force the Bank of Japan to do those things. The politicians are saying that it's essentially the media lying and spreading false rumors. Okay. And you know what? Now that I've covered those things, I literally have only one more topic on my notes. And that's around New Zealand dollar, which has done particularly well in the FX space relative to the other currencies. And it's done so well because the manufacturing PMI surprised like 10 points to the upside. It was at like 50, and then it came out at 59 or something ridiculous. And it was mostly due to new orders. So there were a whole lot of new orders that came into New Zealand that drove a massive amount of growth in the manufacturing sector in New Zealand. And then on top of that, the New Zealand Central Bank, the RBNZ, did a rate hike. So those two things in combination, and again, so long the manufacturing thing has some momentum behind it, things are likely to continue doing pretty well, I think, for New Zealand dollar. The RBNZ also started removing some of the stimulus. So they're also doing quantitative tightening, and they hiked rates. Yeah. There's still also 2 more rate hikes expected. There is also an election in New Zealand coming up in October. It's very, very likely that I believe the Labour Party, the Socialists, are going to win that election because I think the New Zealand First Party is splitting the vote between them and National. So we'll have to see. We'll have to watch the politics of New Zealand as we get closer to October, because depending on who gets in power in New Zealand is going to change the fiscal policy of the entire freaking country. And if they are a lot more stimulatory, you could end up with a much weaker New Zealand dollar. Also, there's supposed to be a sovereign credit rating coming out sometime next year, and New Zealand might actually see a lower credit rating next year if they don't get their budget kind of under control. So if the New Zealanders elect a socialist and he starts spending a whole lot of money, that's almost like guaranteed to happen. Oh, man. It's pretty much guaranteed. Yeah, for a socialist, it's pretty much guaranteed to happen. But right now, it seems like they're going to win. It definitely does seem like it. It'd be interesting to see if anyone is willing to work on that with me in the research forum. All right, you guys. That's pretty much everything that I wanted to talk about today. And we actually got everything in under an hour, or at an hour, right? So I'll go ahead and say thank you guys very, very much. Sorry for no camera. Like, my camera's on, but for some reason it hasn't connected to OBS, and OBS isn't like recognizing it and it's not auto connecting. So, you know, I'm not interested in trying to finagle with it for too much longer. So I'm just gonna say, guys, thank you very, very, very much for watching. If you want to hang out with me and do some research with me along these lines, you can go ahead and hop into the Discord. Link to that in the description. And yeah, also if you need any help still, H2O, H2 operator, H2O producer, go ahead and send me a message either on WAP support or in a DM on Discord, my man. Alrighty, guys. Thank you very much for watching. I will see you guys in a bit.